Hello, scientific investing viewers, and welcome to this new video. And we all know that last few months market has not been very kind. And from my side, I have tried to update in terms of how to track markets, how to understand whether it is a rewarding market to take entry or not. And we had tried to rely as much as possible on data-driven ways. And by this time, there is no single way to say whether the market is topped or bottom. So the idea is to look for multiple indicators, and if more and more indicators indicate the same thing, the probability of success increases. So in that regard, I am going to talk a little more about market and one more method to find where we are. Plus, whenever I make these videos, I get a lot of different kinds of comments and all the feedback. Good or bad, till it's with the right intent, that is welcome. So I will also try to address some of the feedback and some of the questions and all of that. So let's go ahead. So as the most popular question goes, और कितना गिरेगा, और गिरेगा लिया तो और कितना मिलेगा. So let's try to address, and along with that, there are different kind of questions I get. Like one question I have seen is, why to take effort for 15% kind of return, because I have always told that I want to maintain 15% kind of CAGR. If I am able to do it, I'll be happy. And there is a question around, because it looks very simple, because it can be generated even by investing in index funds and mutual funds. So I'll talk a little bit about it. Then whenever markets keep making new highs, buy and hold becomes very popular. Whenever market falls, then people say, okay, there is an importance of selling, so buy and sell is good. So buy and hold versus buy and sell, what matters, and which should be the way out? Where Nifty will bottom or kitna girega? So that is a common question. Are we done with the bottom? And there is one more thing, which is people say never buy when the market is in downtrend. And there are a lot of rules in different kind of market. Different kinds of rules get popular. Sometimes when the value investing is popular, they say buy when there is blood on the street. Sometimes they say never buy something which is less than 200-day moving average. So whether whatever we are talking of never buying when the market is falling down, whether it is good from investing perspective or trading perspective. So we will see some of these questions, and we will try to address where the Nifty will go, how much fall is possible. So let me address first thing, how much returns are possible and all of that. And that itself has a relation to what is the expected fall in Nifty. So if we invested in Nifty, I'm talking about the Nifty index, and if we invested in Nifty index in a particular month, and if we stayed invested for 5 years, the kind of return which we would have made in last 22 23 years, I am presenting a graph of that. Now how to read this chart is, so out of all the months, so take the data from almost 1997, and then we need to take 5 years. So if we are investing in Jan 1997, the 5-year will be Jan 2002. So the last data possible to get this kind of analysis is April 2017, because we will have April 2022 data available, and May 1st of May. So if we take all such months from 1997 till 2017, which will be almost 20 years of data, which will be almost 20 years into 12 months, almost 240 months. 20 to 10, 240 months. So when we take all such data points and we take the return across all these months of investment, what we see is there have been 6% of months when we got negative return despite of holding that investment in Nifty for 5 years. There is 19% chances that there is 13% chances the returns will be 0 to 6%. So if you see, it's a normal distribution where you can see bulk of your probability lies in between, and we end up making 6 to 16% return 55% of time. So there are extreme times when our returns are poor. So 20% of the times we will not be even able to generate 6% return, and almost 16% of the time we will generate more than 20% return. But rest of the time our returns will be somewhere around 6 to 16%. So this is one thing, which means 74% chances are there we will generate up to 16% return. So a probability to generate more than 16% return on a 5-year basis is only 25%. So now I hope you are getting a feel why I say 15% number. I'm tweaking this number a little bit. So this was investing every month, but we as investors, we know that, we cannot just come and invest in 1 month and don't do anything. So what if we are good investors, SIP kind of investor, consistent investor? So let's say we invest monthly, and let's say I know the market is bad. I don't know how long the market will stay bad. So I am going to invest every month for next 3 years. So what I do is now I invest every month for next 3 years, and then I take an average return of all those 3 years, which is 36 months of investment, provided I allow these investments to run for 5 years. So let's say if I invested in January 1997, February 1997, March 1997, April 1997, I am going to take this money out in January 2002, February 2002, March 2002, and then I'm going to do an average of all the returns which I made. So because now you are not doing a one-time lump sum, the standard deviation of the return is going to go down because of SIP. And you can see earlier there were 6% times we were making negative return, but now we don't make negative return because we have been doing a SIP which was spread across all the market conditions for 3 years. So now what happens? 14% of the times will make 5 to 9% return. So if you take somewhere as an average 6-7% return is assured. That is the worst case, but even there the probability is 14%. 46% of the times will make 9 to 12% return, and then 12 to 16% return, 17%. So from 70% earlier, if you see, almost 74% of the times we made up to 16% return. Now up to 76% of the time we are making up to 16% return. But our incremental return probability has decreased a little bit. Earlier we were making 32 to 47% return. With SIP, this also normalizes. So now you can see by this data, to generate a 15-16% return, there is 75% probability, but beyond that it gets difficult because the probability is only 25%. And let me tell you, this 25% has also not been easy in last 1 decade. And let me highlight this chart. So this chart is very interesting, and this chart is also, it will give you a point of view to think in terms of when to book profit and when to invest. And many, at least at an index and Nifty level, this whole theory of buy only when the index is in momentum, I believe that it doesn't work that way. Big money is created when there is there is a lot of attractiveness at the index level. The margin of safety is there, and I'm talking more from a long-term investing perspective, not from a trading perspective. So don't take the advices from the trading side and apply in the investing side. They're two different things. So now coming back to this chart, how this chart works is the yellow line which you are seeing, this is the previous 5-year CAGR. So when I say this return is -2% on 1st of June 2002, it means, so on 1st of June 2022, this yellow line, this point tells the last 5-year CAGR has been -2%, which means the CAGR between June 1997 to 2002 has been -2%, which means we have not made money in last 5 years. And the orange line which you see says from June 2002, what has been CAGR for next 5 years, which means from June 2002 to June 2007, the CAGR generated was almost 32%. So when in last 5 years, the Nifty didn't do well, it performed badly, in fact, negative return, the next 5 years were very rewarding with 32% CAGR return. If I take the reverse situation here, which is maybe September 2007. So in September 2007, if we look, the last 5-year CAGR was 41% CAGR, which means between 2002 September to 2007 September, 42% CAGR was made. But now when we look forward next 5 years from September 2007, Nifty has given almost 0% CAGR. So when you see these lines at extreme, it means if last 5 years were very good, the next 5 years were not so good. And if the last 5 years were not so good, the next 5 years very good. The other thing is, note, till before 2008, you had these 40% kind of peaks possible. But look what has happened after 2008, 2010. In fact, after 2010, there has never been a period when Nifty has given a 20% CAGR over 5 years, whichever month you take. And I'm talking about starting at first of month. It might be possible if you pick some specific day in a given month. But when we pick month over month starting, we have never got a point. So all that more than 20% return, which you saw in this 20, almost 11%, 9, 5. In fact, if we go back, 6, 5, 11, 16% probability of more than 20% return. All of that has happened before 2010. So many times when people show Nifty has given, X% of return in last 25 years, I would suggest you try to break before 2010 and after 2010. After 2010, it has not been so great. I don't know if again we will come back to a time where we can generate a 40% kind of return possible when the GDP grows at 9-10%. But then from last 10 years, people are telling कि GDP double-digit growth rate आएगा, वो आया नहीं है अभी तक. So if someone shows you 20% index CAGR of last 20 years, ask how much in last 10, 12 years. And I, being a conservative guy, I would set my expectations accordingly. And that is why I feel a 15% number is more realistic. 20% at least it has not happened in last 22 years. So 20% return on by investing in index through long-term investing, it's not easy, not a chuchu ka murabba. And 50% of the mutual funds, they fail to beat the index return. And how do we know that which 50% of mutual funds will succeed? So that is why I tell that 15% return is a decent benchmark, at least given by data. And also, I think it gives you a hint in terms of when you have higher probability of generating higher long-term investing return, it's obvious it is when your past has not been good. And when the past has not been good, that means your stocks might not have been in best of momentums. It might be only best of value, but not best of momentum. So long-term investing doesn't work that way. The sooner we learn it, the better it is for us. And this is specifically for index. At a stock level, it could be different. So again, don't interpret or don't conclude one thing for other. In fact, let us conclude it only for Nifty, because all of this data is only for Nifty. So you saw the best of investing returns came when last 5 years looked the worst, not when everything looked rosy. And if you look at even this last 10-year scenario, when your previous 5-year returns were above 20%, your next 5-year returns were sub 10%. When your previous 5-year return went sub 10%, your next 5-year returns were above 10%. So the thing is, it's not a very strong correlation. Let me highlight. In fact, there were periods when both of them were, moving in same direction. But at extremes, this worked well. So whenever you touch this 18-20% mark, it becomes risky for next 5 years. And whenever you touch the bottom mark below 10%, it becomes, little rewarding for next 5 years. But I try to do a correlation analysis. Let me tell you, the correlation was not very, very strong. It was minus 0.26, which means that first it's a negative correlation. So when your last 5 years is good, your next 5 years is bad. When next 5 years is good, so vice versa. But it's not so strong. But where it is working on more of the extreme situations. When your last 5-year return has been very, very bad or very, very good, then it does work, which is, reflected here versus here, here versus here, here versus here, here versus here. And off late, if you see from 2015, your previous return were, greater than 10%, but still your next 5-year return were bad because of the COVID thing. But soon, this improved. If your previous returns were sub 10%, so that is why the importance of SIP comes. If you just invest in a month, it might not be possible. So lump sum is risky. And that is where if you would have invested at least for 1 year, you could have got your returns somewhere between 0% to almost 15-16%. And from here, you don't see a data because still we are yet to see a June 2022 and July and all. So that is how it works. So the question is how to generate alpha, because at a 5-year basis, 15% return looks like the best case scenario. More than that looks very difficult. So is there a way? So I'm changing this a little bit. So from 5-year return, now we are going to 2-year return. So take the same chart, but instead of looking at previous 5-year versus next 5-year, now look at previous 2-year versus next 2-year. Now, when you go from 5-year to 2-year, what you see is your possible returns have increased. And the reason I believe cycles have shortened. Nifty peaks and it starts correcting if you wait for 5 years. But if you are there for 2 years, still you might be able to pick a better peak provided you exit. So in those days, the best of returns before 2008 came the same 40%, in fact, 50-55%. But even if you take after 2020, on a 2-year CAGR basis, there have been times when we have generated more than 20% CAGR. So if you see, we have generated more than 20% CAGR here. We have generated more than 20% CAGR here. We have generated more than 20% CAGR here. So long-term investing is good, everybody talks about, but at an index level, if one has to generate a higher return, I think timing becomes more important. And still, I'm not talking about trading, buying, selling things in 2 months. Still, I'm talking about holding it for 2 years. But when we hold and we make a decent exit, still there are chances of making a 20% above CAGR at an index level. And also, if you see the same reverse philosophy, when last 2 years were very good, past 2 years, next 2 years bad. When the last 2 years were bad, the next 2 years were good. This was a time when it didn't matter. The market just ran in momentum. But again, the same theory came true. Again here reversed, again here reversed, again here reversed. So it proves again and again that when your last few years returns have been very good, lower your expectations for next 2 years. And when your last 2 years have been very painful and you keep doing SIP from that painful period, your expectations should go up. Now, the thing is, in last 2 years, if you see right now, the previous 2-year return, we have hit almost 40% mark in October or December. So last time we had hit this mark of previous 2 years somewhere in 2010. And after that, the next 2-year returns were nothing great. And after hitting this 2-year mark, we have been falling down. And from 40% within 4 or 5 months, this number has come down to 30% CAGR. Now, the question is how much of correction is left and all. So this 20% line on a 2-year basis, I take it again as a caution criteria. So I'm trying to give you multiple indicators through all these videos. And when you see most of these indicators getting ticked, I think I'm not telling exactly time the market go in 0% cash, 100% cash, but think in terms of probability. What are your chances to make higher returns from there or lower returns from there?
Want to be a do-it-yourself investor or trader? Are you interested in data-driven concepts and strategies for wealth creation, leveraging, fundamental, or technical analysis? Learn business, financial, management, valuation and fraud analysis for wealth creation. Learn chart analysis, price volume action, technical indicators and risk management for both trading and investing. Learn systematic investing and trading with full automation using algorithms from scratch. 120 hours of recorded video content across 8 courses, 4 learning tracks, and 2 memberships. You also get a lot of screeners, checklists, dashboards and tools for efficient analysis. So far, we have covered 25 plus companies, 5 plus sectors, 300 plus charts, 4 unique trading and investing strategies, and we keep adding minimum 5 to 6 hours of relevant content every month. As part of practitioner membership, you get to attend regular webinars and meetups, and also access to our newsletters on markets across range of topics. We cover fundamentals, technical, quants, and techno-funda skills through various courses, bundles and learning tracks available through annual and lifetime memberships. Learn from credible minds with rich experience in finance, stock markets, and data science. Explore our courses, learning tracks, and memberships on our app Scientific Investing and our website learn.scientificinvesting.in for more information. For any queries, write to info@theratescientificinvesting.in.
So this says if you want to generate higher return, at least at index level expectation beyond 20%, you don't need to do trading, but this whole buy and hold for 5-6 years may not work, because then your normalized expectation will be lesser and you need to time your entries and exits. Maybe on a 2-year, 2.5, we need to find what is the optimum point, whether it's 1 year, 1.5, 2.5 years, and then do it. And the higher your previous 2 or 5-year CAGR, more the caution required on the next N-year return CAGR on expectation. And especially in a low growth period like 2010 to 20, and we'll discuss about why I'm calling it a low growth period. Also, at extremes, the insights are easier for buy and sell decision. It is the midway where decisions are tricky, and that is why your overall correlation coefficient is not great. It is minus 0.26, but at extremes it looks very rewarding. And in terms of when previous 5 return is very bad, and or even 2-year return is bad, and when it has been extremely good, it does raise lots and lots of caution to book some profit, go in cash. Now, let's come to how much it can fall. That is the question. So now you know a lot of things in terms of what work, what doesn't work, when to get cautious, when to get your sell indicator and all. But how much it can fall, that is the question. And what we have done is we have tried to take the Nifty levels from 2003 to 2022 on an annual basis. Also, we have tried to calculate the Nifty PAT from 2003. And let me tell you, this whole exercise itself took me 2 days, because it's not so easy to do. Even with the commercial databases, the data is not so readily available. In fact, if you look at NSE had a different way of calculating before 2021 April. It was standalone, then consolidated. So for simple data, a lot of effort has gone, and there's an inspiration behind this effort. So this inspiration comes from a book from late Parag Parikh sir on value investing and behavioral finance. And this book is a very data-driven book. It has so many good examples on data-driven strategies in terms of how to analyze market. And he has a hypothesis there that in long term, the indexes or stocks, they move almost as good as their earnings. And on indexes, this is much more relevant. And he has tried to show, and I think this book was there when, around 2008-9, so that data was there. And, you can see in long term, the Nifty CAGR is as good as the Nifty index CAGR. So I thought of replicating the same thing here up to 2022, and then see if the same thing holds true. And don't get surprised by this number. This number is true. I have validated multiple times. So what has happened is between 2018 and 2021, the Nifty profits didn't move much, because, earlier the Nifty itself was growing at 4% EPS CAGR, and then COVID came and it didn't move. But when we look at the last 12 months of data, and what I have done is still the results for all the companies are not out for Q4, but I have taken last quarters of data and current company data, and I've taken a little bit of, projection. But still, because we were hitting almost 1,15 crore kind of profit, I have just extrapolated it. It might be less by 2-3%, doesn't matter. And this is how this number is. So don't get surprised. You can go to trend line. I have made videos on trend line, how to track market results, how to track the Nifty quarterly data, Nifty 500 quarterly data. You can go and you can check it yourself. So this is the data. And then YOY return is how much Nifty index is moving every year. So you can see markets are non-linear. So some year Nifty gives 74% return, some year it gives 5% return, 41% return. And this is what is the year-over-year EPS growth. So even though the Nifty profit grew by 24%, the market grew by 75%. And here, even though the Nifty profit grew by 55%, the market grew by 5%. So we think that if the market is doing very well, earnings are doing very well, market will do very well. In short term, it doesn't happen that way. You can have a very good year in terms of performance and markets may not move, and you can have vice versa also, and all sorts of things. So that is why we say market is non-linear. Why? Because valuation, when you look at valuation, valuation is the actual EPS growth plus perception, sentiment, and the float control. And this is only driven by fundamental. In short term, this is all driven by perception, sentiment, float control. So long term, it's driven by actual growth, and hence in long term, the returns should be as good as EPS growth. So you can see in short term, this 1 year period, there is a lot of gap between the actual Nifty return and the EPS. But when you go long term, and by long term, I mean what I have done is I've tried to find what is the Nifty CAGR return from 2003 to 2022 between 1100 to 16,768. That Nifty CAGR is 15%. And when we look at what is the PAT Nifty has given between 2003 and 2022, what is the PAT growth CAGR from 31,000 crore profit to 4,75,000 crore profit? This EPS CAGR, which is PAT CAGR, is also 15%. So you can see in long run, these numbers are exactly matching. When you see the next row, the same calculation is from 2004 to 2022, then 2005 to 22. So here is your Nifty EPS CAGR for last, 17 years, 16 year, 15 year, 14 year, and this is the EPS CAGR. And then when you see the gap, you can see these big gaps have been reduced to 0.1%, 1%, max 2%. And if you come in lower time frame, so this is like only last 4 year, 5 year view, then you will get little high deviation. Like, Nifty has given a 13% CAGR, but the EPS has grown only at 9%. That means the Nifty is running little ahead of, the EPS. So either the EPS needs to catch up, or in the long run, by the time you finish your 8-10 years, if the EPS is not growing, the Nifty will fall this much that it will get balanced out. If we go by history, that if you look at the last 11, 12, 15 years of data, you will see most of the times your CAGRs are aligned with 1-2% deviation. So even though on a 5-year basis, you might have a higher gap, either the earnings or the Nifty, they will balance it out. And over a 10-year period, if we believe in the same hypothesis, this will again get balanced out. So this is how we should look for this data. And longer duration is 7-year plus. So again, I have said that whenever we look at a 7-year data, the standard deviations of returns normalize. And here also through one more data point, it is visible. So when we say in long run, it means 6 to 7, 8-year time period. Now, either we can do a very good projection of how EPS will grow and we can take a decision. But my belief is whenever we try to do this kind of fundamental analysis, we might be wrong because we are trying to project the future. In technical analysis, it's more reactionary because we don't, support resistance is good, but nobody knows. We draw lines that ye break hua to ye break hoga, ye break hua to ye aega, but we can't say with certainty that this will not get broken until this it shows. So technical analysis is a way of reacting, and here we are trying to find the worst case scenario. So I believe in technical analysis, the worst case scenario is you draw your charts and then you use different levels and all by various methods. But this is another way of doing it where and in fundamental you build some kind of projection. So this is another way of doing and finding where the bottom could be created. And what I'm trying to do, I'm trying to build scenarios. So what we are trying to do is, now let us consider that we are in a downtrend, and let us say we fall up to 16,000, and let us say the EPS last year has grown at a very good rate. So let's say EPS grows at 10%. So this is our scenario 1. So if the EPS growth is at 10% and Nifty falls by 5%, you see all your last 5, 6, 7, 8-year CAGR, most of the times it has gone negative. That means either the EPS CAGR is higher than the Nifty CAGR, or there are few years where it is higher by just 1% or max 3%. So most of the time it looks like your Nifty CAGR and EPS CAGR gets aligned. So I believe if this scenario happens, it's very, very difficult for Nifty to fall beyond 5, 6%. In short-term market may fall, but sooner the market will realize once the number starts coming. So if Nifty can show a EPS growth of 10%, it looks very less likely based on this gap data that Nifty is going to fall further more than this, more than a 1-year correction or a 5% correction. There is one more thing. So right now you saw that the 5-year Nifty return was almost around, let me show you. So let's go back and see what is the 5-year Nifty return. So this is 2-year. If you see right now, the 5-year Nifty return was almost around somewhere around maybe 15%, which has fallen to almost 11%. And if 1 year more continues where EPS grows for 10% and Nifty falls by 5%, what will happen is the previous 5-year Nifty CAGR will hit around 8.9%. And if we look at history again, so when Nifty 5-year CAGR is below around 8.9%. So again, let's go back to that chart and let's go back to the 5-year chart. So when your previous 5-year return is 8.9% or lower, so this mark is like 8.9%. So see, whenever you are hitting 8.9% and you are continuing to do your SIPs, if it goes further down, the next 5-year returns were very good. If you hit again here below 8.9%, your returns have been very good. We are yet to see this period, how the next 5-year returns will pan out. And again, if we get a scenario of less than 8.9%. So history says that whenever your previous 5-year returns were below 9%, the next 5 years have been very good. So that is another way of saying that why I feel it will not fall and it will generate decent return. So you combine the fundamental, you combine the quants analysis, you take both approaches, and then you have a fair idea of, how the risk reward is placed. So again, I am telling it is never about predicting kahan bottom banega, 100% cash mein jana hai, 0% cash mein jana hai. It is all about thinking in probabilities and taking your bets in probabilities and going in partial or more cash rather than trying to 100% time the market. So I believe it gives you a very good idea, and that is what I have highlighted. So this is the benchmark line of 8.9%. And if we start going below it, based on history, it looks like it will become rewarding. And based on what Parag Parikh sir has taught us, and if we do this analysis, it looks, yes, it makes sense. So both ways it falls in line. But let's say if EPS doesn't grow, so, when the growth goes out, things becomes bad. And if EPS doesn't grow and we stay at the same level even for 1 year, in many years, you will see there is a decent gap between Nifty CAGR and EPS CAGR. So I believe that will give rise to pessimism in the market, and there could be possibilities of some corrections happening. So it is very, very important for, Nifty to grow. If Nifty doesn't grow because of inflation or recession or whatever, that is not a good scenario. So again, investing is not about buying or forgetting. It's all about tracking the market and how things are panning out. It is important for Nifty to show some growth, else, correction is possible. And the worst case scenario is, what if, really we hit the recession and EPS falls by 10%? Then of course, at the same level of Nifty, this gap will be very wide and the market will have to fall. So somewhere or the other, if you see, there is a little bit of projection in terms of this approach, where you need to see where Nifty is and a little bit of understanding of, how markets can do. But despite of that, let's say if we do not have any visibility into how the earnings are going to be, still taking a pure quants approach and investing when, last 5 years have not been great. If we do SIP, still chances are that, we'll be able to generate decent double-digit returns. So the key lessons out of all this is, one, let's always think in terms of probability rather than trying to predict a perfect top or a perfect bottom. We need to track regularly because there's a time correction and there's a price correction, and both have their own importance. And we need to see as the time passes, if the market is not going up, where are we in terms of, last 2 years of CAGR, last 5 years of CAGR, and are we coming in that attractive band? Third, there is too much of noise. When the markets are bullish, everybody gives, the targets which are upward, and when the market crashes, everybody gives downward target. But the idea is to cut the noise and look through the angle of data. I think the best of insights come only when, we analyze the data. And fourth, the extreme scenarios needs extreme measures. So I'm not against selling, or, it's not about that, nobody can time the market. It's not about predicting, 0 or 1. But I think these are the extreme situations where decision making is always easier because you have history in front of you. But that is the time when the greed and fear takes over. So we need to keep the greed and fear aside, and we need to take those extreme decisions in terms of, if it is very lucrative, go all in. If it is very, very expensive, book decent amount of cash. And last is time it, but don't time it. What I mean is, it's not about predicting an exact bottom or exact top, but it is about timing so that we have a sufficient amount of cash when the situation is very risky and the chances of money making is lower. And when the market looks very, very attractive and there's a pessimism around, use that cash and deploy that cash. So in some way, we are trying to time the market, but we are not timing it in the sense which is, generally said about in the market of identifying the perfect top and bottom. So I believe all of this was useful, and you got one more perspective, one more data point, one more analysis to, identify how, how to play and how to, manage the drawdowns in the market, and how to, make a decent use of cash, how to generate cash. One key announcement. So a lot of things, what you see behind it, there is a lot of Excel analysis and all which goes. I'm happy to share the deck. I'm happy to share the Excel, but we need a platform. So I have a LMS. What I will do is I have created a poll. So you can go to the community page and there is a poll. Participate in the poll. The poll is regarding will you like to pay a very bare minimum amount, maybe 100 rupee for annual subscription if you want access to these PPTs, these Excel sheets, so that you can work on your own. Participate it, and if there is enough interest, then I will try to create a course and I will give all of you access with that bare minimum amount, which is more just to sustain, because for these platforms we need to pay almost 1.5 lakhs every year. So if that is the case, there is enough interest for that bare minimum amount. You want access to these backend resources of Excels and PPTs, I will provide that access to you. So do let me know and do participate in the poll. I will see you with another video soon. Thank you.